Hi. In today's video, we're going to talk about investment trusts, which are a really cheap and simple way to invest in the stock market. Now, the first thing to say is that the name is misleading. Investment trusts, they're not really a trust, they're a company that invests in other companies. And the company is run by a fund manager or team of managers who pick the right stocks, and then that manager is supervised by an independent board of directors who make sure things are going in the right direction. And those independent directors are great. You don't get them with other investment funds such as unit trusts or OICs. Now, the biggest advantage of an investment trust is that the charges are normally relatively low. So with a unit trust or an OIC, typically you'll be paying an annual charge of around 1.5%. But with an investment trust, charges are often more like 0.5% a year or get pushing up to 1% a year. So you might be able to save 1% a year with an investment trust. Now, that doesn't sound great at first, but actually if you stay invested for 10 or 15 years, that 1% saving will compound over the years and make a substantial difference to the size of your investment when you finally come to sell. Then another big advantage for investment trusts is the opportunity for a discount. So let me explain what a discount is. So let's say we've got an investment trust called Eds Investment Trust. I'm the manager, and it's a really nice and simple investment trust. So there we go, Eds Trust. And currently the assets in that trust are worth £50 million. So we've got, let's say, 10 million in Tesco shares. We've got 10 million in HSBC shares. Let's say 20 million in Marks and Spencer's. And let's say 10 million in Vodafone. That's a really simple trust. Most trusts will have a much more complicated portfolio with way more stocks. So we're just keeping it simple, and so the assets in this trust are worth £50 million. Now, let's imagine the trust also has 50 million shares out there, so there's 50 million shares. The assets are worth £50 million. So you might think the share price would be £1 a share. And if this is a unit trust or an OIC, the unit price, terminology is a bit different, but the unit price would indeed be £1 a share. But with an investment trust, the share price will almost certainly not be £1 a share. More often than not, it'll be less. And the reason is that the share prices of investment trusts are driven by supply and demand. They're quoted on the stock exchange, so it really depends what the demand is on a particular day. And of course, that demand will at least partly be driven by the value of the assets. But investors will also be thinking about what's going on in the market and how much they like the fund manager. And am I doing a good job as manager of the fund? So typically, trusts normally trade at a discount. So let's say the share price might be 90p a share. So it's 90p a share, the assets are £1 a share, the fund is trading at a 10% discount. Now that's attractive because you're buying something that's worth £1 for 10% less at 90p, which is great. And it also means that if you pick the right fund and the right fund manager, hopefully my investments will grow in size. So in a year, the assets might be worth 60 million. And also, the discount might narrow from 10% down to 5%, and so you get a double whammy, gains from the portfolio growing in value and gains from the discount narrowing. Now, I should also say that some investment trusts do actually trade at a premium, so instead of a £1 share price, the share price might be at £1.05. And that normally happens when the manager really thinks the fund manager is a brilliant stock picker. Personally, I'm very reluctant to buy an investment trust at a premium. I just don't really see the point in paying more than what the assets are worth. And then the final advantage of investment trusts is the fund manager has the ability to borrow, and he can't do that if he's running a unit trust or an OIC. So let's say I've got £50 million invested in shares, there's no cash in the trust, but I think actually, wow, the stock market's looking cheap, I want to buy more shares. I can go out and borrow, let's say another 2 million, and buy some extra shares and boost the size of the portfolio. And if that portfolio then grows, we get an even bigger gain because we borrowed. We're gearing up and boosting our gains, which is great. The only disadvantage is if I make the wrong investment decisions and the share prices go down, then I actually boost the sizes of the loss. So there's a potential for bigger profits, but also potential for bigger losses because I can borrow. But I really like that potential. It means the profits can be bigger. So overall, I really like investment trusts. I especially like their cheapness and their simplicity, and I think everyone should at least consider including some in their portfolio. And if you'd like to learn about other ways to invest and other investment tips, take a look at our video website, moneyweekvideos.com.